Good afternoon, everybody, and welcome to our webinar. Today's speakers are Mark Dicken, Agricultural and Property Partner, and Nicola Hart, Senior Tax Manager. If you have any questions after this webinar, please put your questions in the Q&A box at the bottom of your screen or on the top of your screen, and we will answer them at the end. Thank you. I'm now going to hand you over to Mark.
Okay, thank you, Sharon. So as Sharon said, we're going to be covering basis period reform today. We don't really want to get into too much of the nitty-gritty detail, but try and keep it high level with some practical examples that hopefully makes you think about how these rules may affect your business. So in terms of what we're going to cover, Nicola's going to run through the proposed changes, who's going to be affected, what the rules are currently, what the new rules are going to be, what the transitional rules are, a little bit about capital allowances, and then I'm just going to cover thinking more practically about how the changes will affect businesses and clients that we look after here at Ellacotts. So yes, as Sharon has said, I mean, you probably will have some questions, so please don't hesitate to put them in the chat and we'll deal with them at the end as best we can. So I'd like to now hand over to Nick, who will talk through a bit more of the detail.
Thanks, Mark. I thought it'd be useful to run through some of the basics to start, although I appreciate that many of you will be familiar with this already. So in autumn 2021, the government announced it was going to change the way that trading profits are taxed for income tax purposes. These changes affect individuals who are self-employed, including partners in trading partnerships, if their accounting periods are not aligned to the tax year. The new rules also apply to LLPs. The new rules do not apply to individuals running their own businesses and operating through limited companies, just those who are registered with HMRC. Many businesses have accounting periods to the 31st of March, and for these purposes, counting dates from 31st of March through to the 5th of April will be treated as being aligned to the tax year. So if we recap on the current position, currently, for income tax purposes, trading profits of a tax year are generally based on the profits of the 12-month accounting period ending in the tax year. This is known as the current year basis, and this method of taxing profits has been in existence for about 20 years. For example, if accounts are drawn up to the 31st of December 2022, they are taxed in the 22-23 tax year, as the slide shows us, and the tax return filing tax payment date are the 31st of January 2024. Under the current position, the advantage of having an early tax year, or an early accounting period, such as the 30th of April, is that it will allow more time for planning. So a 30th of April 22 year end means that the tax liability won't be due until the 31st of January 2024, giving the business time to plan its cash flow, reduce payments on account where appropriate, and to decide whether to make any pension contributions before the 5th of April 2023 deadline. It is useful at this stage to mention overlap profits, which many of you may have. And you'll now be able to utilise as a result of these changes. So under the current regime, and because of special opening year rules when a business commenced, there may have been a situation when a portion of the profits would have been taxed twice. These profits are known as overlap profits. And to eliminate some of the double taxation rising in the early years, overlap relief would be given on cessation of the business, or sometimes where the accounting period had changed. Basis period reform has now introduced another occasion where relief can be obtained for these overlap profits. It's also worth mentioning that the overlap profits, the details, might not be readily available for all businesses, but it may be possible to obtain them from HMRC or calculate them. So how will the new regime work? From 24-25, the intention is to tax profits of the actual tax year instead of the profits for the 12 months to the accounting date that ends in the tax year. Businesses with accounting periods ending the 31st of March will be unaffected by the changes. However, where the accounting period is not aligned to the year end, taxable profits will be based on time apportioned profits that fall within the tax year. So looking at our example, if a trader draws up their accounts to the 31st of December every year, their profits for 24-25 tax year would be based on the apportioned results of 2 accounting periods. This would be 9 months of the 24 calendar year profits and 3 months of the 25 calendar year profits. So whilst this looks relatively simple on paper, it will no doubt cause many difficulties in practice. 24-25 tax return will need to be submitted to HMRC by 31st of January 2026. So unless the business is very simple, it is unlikely that the accounts for the 2025 calendar year will be finalised by this date. It may therefore be necessary to file the tax return for 24-25 based on provisional figures for the 25 calendar year accounts. The tax return will then need to be revised at a later date to reflect the true figures when the actual figures are known and the accounts have been finalised. This exercise would need to be repeated every year, and it would add to the administrative burden and associated compliance costs. So we've looked at the old rules and the new rules, but the 23-24 tax year is going to be a transitional year. And in this tax year, we are moving from the old regime to the new regime, and special rules apply because in the transitional year, it's likely that more than 12 months of profits will be taxed, and this will create an increased tax burden on the business. So, for example, if the trader prepares their accounts to the 31st of December every year, the profits for the 23-24 tax year would be based on the whole of the 23 calendar year accounts, together with 3 months of profits from the 24 calendar year accounts. Therefore, 15 months of profits would fall to be taxed. To eliminate this potentially increased tax burden, a deduction is given for unused overlap profits, as mentioned earlier. So let's look at the taxation of the transitional profits. In the transitional year, which is 23-24, taxable profits will effectively fall into 2 parts. The standard part, which in most cases will be 12 months from the end of the previously taxed accounting period. And then there's the new transitional part, which runs from the end of the standard part through to the 5th of April 2024. Overlap relief will need to be taken into account at this point, and it's not possible to defer this and save it up to use later, as currently overlap relief is generally used on retirement or cessation, or in some instances where a business chooses to change its accounting period. It's also worth noting that there are complex rules that exist for when profits or losses arise in the standard part or the transitional part. And there are different rules to how these can be relieved. We don't have time to cover this presently, and each case will have to be examined on its own merit. So to alleviate the burden of having to tax more than 12 months of profits in the transitional year, special spreading provisions have been introduced with the option to tax the transitional profits spread equally over 5 years, including 23-24 tax year. So in our example, which you can see, the standard profit is £50,000. The transitional part is £30,000, and we have overlap profits which can be relieved of £10,000. The total taxable profits then, if the trader elects to be taxed on them sooner rather than later, is £70,000. However, if the spreading provisions are applied, then the transitional part less the overlap relief amounting to 20,000, could be spread over 5 years, starting with the transitional year 23-24. And this would mean that the taxable profit for 23-24 would be 54,000 rather than 70,000. So you may be wondering how this interacts with capital allowances. And basically, capital allowance will continue to be calculated on an accounting period basis. This means that additions and disposals will be made to and from the pool for acquisitions and sales arising in the accounting period. With regards to the annual investment allowance, this will continue to be given for businesses' accounting periods and will be prorated accordingly, depending on whether we have a shorter or longer accounting period. The writing down allowances claim will form part of the taxable profits or losses for the accounting period. So basically, it's the overall profits and losses after deducting capital allowances, which will be allocated to specific tax years and prorated accordingly. So if a business does not want to time apportion its profits and potentially submit estimated tax returns and then have to amend them when the accounts are finalised, what else can they do? I'm now going to hand you over to Mark, who's going to run through some options with you.
Thank you, Nicola. Yeah, it's interesting, really, this whole basis period reform. I wasn't in practice, I wasn't doing this job 20 or so years ago when the whole overlap profits and current year basis taxation was introduced. So it's all I've ever known. So in a way, it's quite refreshing that it's being sorted out. It's just a shame that it's going to involve a bit of sorting out for particular clients, as Nicola said, non-5th of April, 31st of March year ends. Personally, I cannot imagine having to prepare tax returns, apportioning profits from different tax years to try and arrive at something. I mean, it's hard enough quite often to just do one set of accounts and tax returns, and a lot of work involved in that. So I think practically we're going to see a lot of clients changing their year end so that it just then aligns with the tax year, which seems to be quite a common sense thing to do. So take advantage of the fact that we've got the transitional provisions available, and use the relief where we've got it, and then going forwards we'll have accounts prepared on the 31st of March or 5th of April basis, so we don't have to worry about this apportionment of profits. But that then turns to the issue of, really, it's just what this means in terms of what the tax liability is going to be, and there's going to be an acceleration of tax. But I think the important thing to focus on is what the rate of tax is going to be. I mean, that's always the most important measure of the tax burden on a business. It's not so much the quantity of tax, because if that's relative to your profits, it's actually what the rate of tax is. And so for some businesses, we may just simply be able to extend the period of account, and there will be very little. There'll be additional tax, potentially, yes, but at the same rate of tax. So in actual effective rate of tax, there isn't really a consequence other than cash flow. But for others, there is going to be this acceleration of profits, and those profits being taxed at higher rates. And I think that's the thing to understand, really, practically. What do the profits look like in this period that we're in now? Because the transition period is this tax year that we're in now, 23-24. So particularly clients who say 13th of September year ends, this is September 23. We're going to have 12 months, and then we're going to have 6 months through to the end of March. And so for me, looking after, particularly as I do, farmers, we've had a lot of fluctuation in terms of profits over the last few years. Profitability actually is now coming down with commodity prices falling and other costs, inflationary costs, catching up. And so it's going to be a question of just considering each client based on what we think their particular profit's going to be. But in terms of reducing profits in overall terms, we've got pension contributions, which are still an effective way of reducing an individual's tax liability through the tax relief that is available on pension contributions. So that's something to be thinking about, to try and time pension contributions with increased profits, so that in overall terms, we're still looking at a similar rate of tax. From a farming perspective, we're fortunate to have farmers averaging, which copes or is there to recognise the fluctuation that we see in farming profits. And so farmers averaging will provide potentially a bit of relief, but farmers averaging can only go so far. Again, it comes back to what rate of tax you're paying. So that's a possibility. But also capital expenditure, we still have the ability to write off purchases of plant and machinery against trading profits in the year in which that investment is made, generally speaking. And so that provides an opportunity to reduce profits, and therefore the implication of having more profit taxed in one tax year will be lessened because you've got the relief from investing in machinery. So there are quite a lot of variables there that I think will help to ease the burden of this actual spreading situation that we've got, the bunching together of tax liabilities. So yeah, I suppose, yeah, to summarise really with regard to that, some businesses, it's more of an administrative change. More profitable businesses, I think there just needs to be a bit of thought as to when the profits are going to arise, and therefore what action can be taken now, or certainly within this current tax year, so before 5th of April next year, to try and mitigate the increased taxable profits that we're going to see. I mean, having said all that, there still exists the opportunity for partnerships, sole traders, to look at incorporation, which in the past has provided lower rates of tax on trading profits, but we are seeing that the position is more marginal now, in that we've seen corporation tax rates increase from the 1st of April this year. Dividend taxation is increased, the dividend allowance is coming down. So companies still have a role to play, potentially, if you're looking at restructuring, if you've got a profitable business where you're looking to retain profits, to reinvest in the business, repay debt. It depends on a whole mix of variables, but we still have incorporation to look at that might now be relevant to think about that in the whole context of this situation that we're in at the moment. And I suppose the only other point to mention is businesses are continually changing. We're seeing succession of farming businesses, seeing the next generation of the family coming in as partners, and so that may also provide more opportunity to share profits against more partners in the business if more partners are introduced, if it's right from a succession planning perspective. So, you know, as always, there are quite a few variables that we can be thinking about if this is going to be a particular problem, depending on your particular business. So yeah, there's no particular sort of one size fits all. It's just thinking about the individual businesses and then weighing up all of the variables. So I think that's pretty much all that we wanted to cover, really. So if you've got any questions for us, I don't know whether we have any, Sharon.
Yes, one's come through already. How does this affect other partnerships' untaxed income?
Yeah. So basically, the untaxed income will follow the new regime as well. So, for instance, rental income will be taxed under the new regime, with more profits falling into the transitional year. But unfortunately, for rental income, there is no option to apply the spreading relief provisions. So this could potentially be quite expensive for some businesses.
Yeah, I mean, I think that's right. I mean, we have a lot of particularly farming businesses with property income, so we are going to have that bunching of the rental income, and that's when thinking about the farming business and the profitability or loss-making position of that business. If there's investment in capital allowances, again, trying to match the two and try and, in overall terms, get to a situation that is better than it could otherwise have been, I suppose. Yeah.
If anybody's got any other questions, please pop them in the box.
I mean, I suppose to add, I mean, the simplest thing seems to be to look at changing the year end. It may not be appropriate. There may be a particular reason why you've got a particular year end. So the rules do allow you to carry on with your current year end, but it won't. But by doing that, it still doesn't get over this acceleration of profit. We're still going to have those transitional provisions. So, yeah, it may be that some do decide to stick with the year end. There may be a particular reason why that year end is appropriate. So yeah, I think, you know, the things that we've talked about as well, they're thinking about pension contributions and investment in machinery. Everything is they're always restrictions on what you can spend money on, and there are reliefs, there are allowances, and it's all quite, well, a lot of rules, aren't there, and restrictions, particularly on the extent of tax relief that you can get. So that's why it's always better to talk it through, you know, bounce things off us. A quick phone call is better than, you know, investing lots and lots of money in a pension and then realizing that you don't get the relief anyway, because you only get relief on pension contributions in respect of trading profits, not in respect of rental profits. So it's just, it is a complicated system, and so that's why you know, call to talk things through is always valuable and time well spent, particularly with this sort of thing where it's quite this one-off that we're happening in this year. It is quite a big thing to be thinking about.
Well, as there's no other questions, I'd like to thank Nick and Mark for doing this webinar today. If you do have any questions that we haven't been able to answer for you today, please contact us to discuss in more detail. Thank you, everyone. Have a good afternoon.
Thank you very much.
Thank you.